Welcome to BPM's IPO Readiness Roadmap, a series of conversations with our leaders who have been there and done that when it comes to leading companies to go public or consider the option that may be best for them. I'm John Weems, Head of Business Development at BPM, a top 50 U.S. accounting and advisory firm. Today, we are focused on vital short and long-term executive financial hires that will increase enterprise value and help you gain access to real-time financial information to run your business. Our experts today are CFO Services lead partner Terry Hill and Director Brenda Rose. They bring experience with more than 200 investor relationships and 500 plus transactions in the past 6 years. Beyond work, Brenda also happens to be a professional violinist, and Terry is an Ironman triathlon veteran. So they bring the skills that you need to orchestrate teams and power through business cycles in times of challenge and triumph. I've also learned that Terry doesn't just use generic Zoom backgrounds. He actually took that photo of Crater Lake behind him. So you have all kinds of talent at your disposal. Terry, let's start with you. And though this program is called the IPO Readiness Roadmap, could you comment on how your team works with executives and companies to look at a range of outcomes and have the right people on the bus or the jet to get to their destination?
I think people use IPO as a bit of a euphemism. Generally represents for founders, sometimes for boards, and for CFOs if the business has one. If I think about the universe then that encapsulates, it's obviously the traditional IPO. And I think people at least know from a distance what that kind of looks like, and they're familiar. We have seen a huge emergence of the SPAC structure these days, which is a NASDAQ listed blank check company. Actually, it's been around for 20 plus years. It's just become very, very in vogue the last 18 or 24 months. There are really tremendous opportunities for some companies in the private capital markets. Huge amount of dry powder there and investors that are often extremely bullish on either companies or the vision for a company and a product. The CEO, the board, the founder, co-founder, and the CFO, if the company has one, aren't always on the same page. And that's normal and natural. People have different timelines and different sensibilities. So I think one of the first things that you'll want to have happen is that those folks should at least become aligned, or at least understand what kinds of trigger points exist for each of the constituent parts of the company. And we're delighted when we can have those conversations and help facilitate some critical thinking. These processes, whether it's a public company endeavor or a private capital transaction, are at best case a buzzsaw and chaotic, and they're hard. So getting ready is critical, and being able to tell your story and evidence the company and its people and the mission and the product are really going to serve people extremely well. And if you miss the opportunity for that, sometimes the deal just dies entirely, or you may just lose a significant amount of enterprise value.
So Brenda, let's say you and Terry are in one of these situations, you're working with a client and you've identified some of these gaps and challenges and bandwidth within the executive team. What next?
Well, like Terry said, these things are tricky. And so we often do identify gaps. And there's a couple of different types of gaps that we see. One is clearly a bandwidth issue. And the other gap refers to expertise of the finance team. For example, we may have a very savvy CFO and controller on board at our client, and they've been through similar transactions before, but they just need help getting across the finish line. They basically need clones of themselves to help them because there's just not enough hours in the day. And then we have other companies who, they may have bandwidth to take on extra work, but they simply have no idea really how to prioritize what needs to be done, or even what needs to be done, or how to do it. So to have the most successful outcome as possible, it's very, very important to have the right expertise on the team. The next question is really to look at those things and ask themselves, do we need these things in the short term, or is it more a long-term need? As an example, many of the projects that our CFO Services team works on relates to getting a company ready for an IPO or SPAC. And so the urgency of that situation requires us to parachute someone in to assess what's needed. And one of the first things that we often look at is the organizational design. And many times what we need to do is put a short-term interim professional in who can both advise on what needs to be done as well as execute and be that bandwidth. Other times it's apparent that they need a permanent expansion of their team or a permanent upgrade in the skill set that they have. And in that case, we recommend the retained search option.
Well, let's kind of look at the very short term and the retained search. On the very short term side, Is any timeline too short for you two? I've heard legendary tales of, it's midnight Thursday. Are you always ready to spring into action?
Absolutely. That's what we do best. And you're not kidding when something happens on Thursday or Friday and they want help by Monday. And that's really just comes from experience, understanding the types of needs that these companies have when they're approaching a situation like this. So we have our team, we have our CFO services team that we can parachute in, and that's backed by 600 other professionals within our CPA firm.
So Brenda, let's say that need has been identified. We know that a world-class CFO or controller is required. It seems like there's a lot of available talent out there. Why does retained search make sense?
There's different types of recruiters, and they're not created equal. And I've dabbled in all of those worlds. So first, I guess I'll mention the fundamental difference between retained and contingent recruitment. Contingent recruitment agencies will generally take on a search, agreeing that they'll only get paid if they supply the candidate that eventually gets hired. And a company can hire several of these contingent recruiters all at the same time to race against each other to get to the finish line. And so the problem becomes, because speed is so important to beat the other recruiters and to get paid, these recruiters typically will look at their database or they'll post ads, and they'll get candidates who are currently unemployed and who are just ready to jump right in. And so these unemployed candidates are a very, very small piece of the entire pool of candidates that you should be looking at. Retained recruitment differs from that in that you have an exclusive relationship. The recruiter will complete the search and you will pay them. They will get paid for that. So therefore, these retained recruitment professionals aren't afraid to spend that extra time, the enormous amount of time actually that it takes to do a good job. And in doing that, they'll uncover a much better selection of professionals for you to choose from. With the right approach, these people will respond and look at new opportunities. As a matter of fact, we do retained search here at BPM, and we get constant feedback from professionals that we recruit that they say they don't typically respond to recruiters, but because we're under the umbrella of a CPA firm with that credibility, and because we present our client and represent our client in a very professional manner, they're compelled to respond to us and to ultimately consider that job opportunity.
Terry, you had mentioned that BPM certainly works with executive teams, with senior finance execs. I understand that you enter multiple vantage points. You may work with a board, with founders, et cetera. Can you comment a little on your work from those other points?
I mean, first and foremost, we want to help our clients and their constituents avoid surprise and understand, have a realistic, unvarnished view of what a process is going to take, what valuations may look like, what the sort of liquidity, timing, and preferences of various stakeholders are going to look like. All of those things both drive, decision making, as well as how likely it is people be aligned, right? So having those conversations early on is really valuable, and having, to your point, beyond just the office of the CFO in the conversation is critical. We don't always have that luxury at first. Many times we're hired by the CFO, and we're delighted to be so. But pretty soon after, it's really important to understand the founder's aspirations. Founders are always getting feedback from advisors and from other folks around them, bits of valuation, and sometimes those valuations might or might not be realistic. And then the board is always important. I just had a call today with a client, and got a really, really good dose of feedback on what the board is thinking and some of their renewed excitement. So that may affect the timing of an IPO or a SPAC deal or a private transaction. For many of these companies, especially those looking for an IPO or a SPAC, which is inherently a minority transaction as opposed to a buyout or a majority transaction, these companies are forced to take their legacy of finance and growth focus and shift towards, very abruptly so, towards compliance and risk mitigation and transparency for a public filer. That is not easy. And to Brenda's point, that often takes new skills. It takes certainly more bandwidth. Having that alignment of board and CEO and founder and CFO is critical. And understanding the company's readiness and what it's going to take to go through the deal is critical. The promise of SPACs, at least for many, is that the transaction is going to go faster. It's a kinder, gentler, easier way to get to a public company. And that may kind of seem like the case. In the case of a SPAC, you do the deal and then you do the public company stuff after, right? And the IPO track is a little bit more do all the public company stuff and then do the deal after. The process ends up looking fairly similar. And in fact, with a SPAC can sometimes feel a little bit protracted based on the promises. Both can be very attractive scenarios for founders and shareholders, but I think it's critical, again, to have a sort of eyes wide open approach of what's realistic, what it's going to take, right? Bring in some outside advisors. You can rent expertise and bandwidth and acumen. You don't need to hire for it on day one. In fact, oftentimes, to Brenda's point, to have the permanent staff suitable for the future state of the company for the next 5 years, those skills are going to be different than the next 6 months.
So Terry, let's move from the hypothetical to to the road. I know you and your team have worked with 200 billion funds. You've also worked with smaller family businesses. Can you share a couple of examples where it all came together?
We're blessed with meeting really cool emerging companies with really cool founders, and those companies have large venture logos supporting them, and their path to IPO and SPAC is sometimes a little more obvious than others. We've got 40-year-old startups, right? So a founder who now is 65, 70 is looking for their retirement event. And they have many of the same needs and requirements to take that ownership transition project and make it a reality. And then we have, to your point, we have investors, whether they be late stage venture or some of the world's largest or the US's largest private equity funds. They require support on the buy side. So they've made an investment. The company, much like an IPO or a SPAC, the company isn't quite ready to comply with very, very stringent reporting requirements and sometimes compliance requirements for the investment fund to build on their strategy for the platform. So we can provide advice, we can provide operational intervention, of course, for our team specifically. We can provide interim leadership as well as full-time hires. And as Brenda mentioned, we're surrounded by the expertise of the firm. So we've got SOX expertise. We have expertise to help with quarterization and the filings of the S1, S4 as examples. And in the case of private company events, many of these family-owned businesses, although very, very successful, have been run largely for the benefit of the founders, which is fine, and largely in some cases to the benefit of a tax situation, right? So now you've got to actually evidence profitability, and you've got to be able to tell your story and survive the process of diligence. And much like a public company transaction, although we don't need to have everything perfect, things need to be good enough that they assuage any shadows of doubt, right? A diligence team for a buyer where there is doubt and uncertainty can do only two things. They can kill the deal because they have people that they report to and they can't fake that, or they can price in the risk. And in many cases, this will diminish enterprise value by 10, 50, 100, $500 million for the company. So being prepared is critical. Being prepared to tell your story and survive diligence, whether it's a SPAC transaction or a private capital deal. And then getting ready if you're going to be a public filer for the very, very different requirements of reporting and transparency, timeliness, right? And the flow of information from your team and into the markets is critical. So we can and have helped with all of those things and are delighted to meet founders and families and boards and CEOs because they're all just a ton of fun. Maybe one more thing to mention in closing is that the things that our clients are going to do with regard to preparedness are going to look the same and different. So if I think about our current clients, we have an implied $2 billion valuation in a consumer company looking to do a SPAC. We have life science companies that are doing IPOs anywhere from $500 million to $1 billion plus. We have families that are selling companies for $20 million, or in one case, I've got 3 shareholders selling a healthcare business for about $600 or $700 million. And although those look like very different kinds of transactions from the outside, they're pretty similar from the inside and from where we help intervene functionally. So all I would say to the listeners is that don't fret too much about what kind of a deal will be on the other side. and know that much of the themes and much of the work you'll do in the preparedness and the getting ready side, until you get to the sort of 70% or the 70-yard line, are going to look similar. And then you can start to do the fine tuning that's required for a public company or a private capital exit. But don't fret, get good advisors, get good people around you. And to your point, John, we're always happy to have a conversation and see how we can help and share a perspective on what the process may look like and how long it will take.
Well, Terry, Brenda, thank you for joining us today and for your time. And as you say, I know you are happy to have individual conversations, no cost, and explore what option may make sense for some of our listeners today. We invite them to connect with you via LinkedIn, and we ask everybody to subscribe to BPM's YouTube channel. Please stay tuned for some of our upcoming episodes. And again, we are always happy to answer your questions along the way. Thank you.